Hi friends, this is the Ashwini Rastogi. So we have so many questions. Income tax department, how to tax digital economy? Is there any GST liability? If you are doing business through the India, seated at outside India, is there tax liability arise in India? Number of example you see: Netflix, Google, and so many OTT channel, so many web services provider, app provider are seated outside India, targeting customer base in India. Those are earning income from India. Is those are liable to tax in India? So let us discuss what is the tax liability and how the income tax department and GST department levy. So first of all, we discuss income tax. As you know, income tax is levied. Income tax is levied on the income if you receive from India, on the basis of accrue arise in India, on the basis of deemed to accrue arise in India. In respect of non-resident, those income for which income arise from India. So this is the actual scenario where the income is taxed under the Indian law. So domestic law says income is taxed even though if you are permanent establishment in India. If you are some business connection through the SAP, SAP is a significant economic presence. If you are doing some kind of business, then you are liable to tax to the extent of profit attributed from India. So this is liable to tax in India. So now we discuss what is the GST liability. I discuss one of the famous example. Suppose you are making a website, you are making some kind of application. You are taking services from GoDaddy. GoDaddy is US based entity providing services to you. You are seated in taxable territory in India. So, what the OIDAR regulation says, if a person is providing services from non-territorial service country to a person taxable country who is not liable to tax, then OIDAR registration need to take by the GoDaddy. So the GoDaddy is required to charge GST from you and pay to the Indian government. This is the scenario. Even so, though so many e-commerce operator is working in India, you are a seller selling your goods to the e-commerce operator. Suppose you are selling through the Amazon, Flipkart, and so many things, then e-commerce operator is also liable to collect TCS from you as a vendor. So this is the scenario under the e-commerce operator is required to collect TCS and OIDR registration under the income tax act. Suppose you are registered as a taxable person in India and you are charging service, you are taking services from the GoDaddy, then in that case you can provide your GST number. Under that circumstances, Section 14 of GST Act is applicable. You are not required to pay tax to the GoDaddy. GoDaddy will not charge anything, but under the reverse charge, you need to pay taxes. So, what is going on and what is the future regime of digital taxonomy? Now, let us discuss. So, BEPS is Base Erosion Profit System project of the OECD G20 countries. OECD is says BEPS 1.0 already in phase. OECD released 15 action plan. Action 1 is in respect of challenges under the digital tax economy. So all 15 action plan already in force, implemented through the Finance Act in phase manner. Now BEPS 2.0 pillar 1 pillar 2 approaches going to be implemented. They are OECD is discussing how to tax under the new era of digital economy. So, under the phase manner, they are discussing how the tax is levied. It would help in avoiding double taxation and levy of tax where they are source of economic profit situation. Suppose you are doing business through the Mauritius or some tax haven countries, you don't pay anything taxes. Then in that case, minimum tax is levied under the pillar two. So OECD is suggesting some kind of phase manner tax is levied. So now we discuss what is the India's spread on digital taxation, background to digital taxation. So first of all, equalization levy, it is a Google tax, online advertisement provision of digital advertising space services, which is applicable from the 2016. Suppose you are taking services from the Google Ads, your website is running on the top of the page, then you are required to pay equalization levy. This is the outside the income tax purview. You don't Google, for which not have a P in India, is liable to tax in India. So there is a new nexus theory, significant economic presence in 2018, introduced EL 2.0 on online sale of goods and services in 2020 recently. Introduction of withholding tax on e-commerce 2020 with the recent addition of virtual digital uh, transaction, virtual digital asset taxation. Suppose you are selling some kind of cryptocurrency, Bitcoin, then you are also required to pay taxes, also required to deduct TDS on such transaction. Deeming provision under section 14, as I discussed, OIDAR, which already in phase. Section 52 talk about TCS under the GST provision, for which e-commerce operator is required to collect from the vendor. So significant economic presence, a new digital business connection. Significant economic presence SEP provision in the domestic tax law have recently widened the scope of term business connection. Under the income tax, income is liable to tax if you are doing some kind of business. There must be a business connection. Section 911 says if you are doing business through the India, then you are liable to tax. So a non-resident has significant economic presence irrespective of agreement of such transaction is entered outside India or India. Non-resident has residence or place of business in India. Non-resident renders service in India. Then you will trigger significant economic presence. The aggregate payment for arising transaction in respect of goods or services carried out by non-resident with person in India, including provision of data download software, exceed 20 million, then significant economic presence is counted. Suppose in case of Netflix or some OTT channel provider is providing some kind of services and number of user is exceed 3 lakh, then SCP is counted. Same way, SCP provision is already been deferred till assessment year 22-23, which was initially introduced under the Act in 2020, is deferred by reason of so that equalization levy of 2% they should prefer. They doing a business through the India, selling goods through the India, providing services through the India, then they should pay equalization levy at 2%. That's why the SCP provision has been deferred. But now SCP provision is already in phase. The government has already introduced threshold 3 lakh user, 20 million revenue. So SAP provision is triggered. So let us understand equalization levy. So first of all, equalization levy is levied from 1st June 2016 on the specified services. That is called Google tax. Online advertisement, any provision of digital advertisement service, any other facility services for which EL is taxable at 6%. EL 2.0, which is applicable from the 1st April 2020. So EL is applicable on the sale of goods, provision of services, and sale of goods or services by the e-commerce operator or any combination. So 2% is liability is there under the e-commerce. So now we discuss, if the EL provision is applicable, then withholding tax provision under section 195 is not applicable. Since EL is not required to report their profit as per the P status, which is exempt under section 10 sub section 50. 1050 profit is exempt, so no required to report profit on TDS liability. So EL scope and exception. No, EL normally apply to the online supply of goods or services which is provided to resident, but may also apply to non-resident in the following circumstances. If you are providing some kind of services to a non-resident who are actually using IP address of India, then EL provision is applicable. So IP address location is also the matter. So where the EL operator has P in India and supplies services effectively connected with such P, then EL provision is not applicable. Then their income is taxable as the P entity. Normal provision is applicable. Income is taxed to the extent of that is attributed to the Indian profit. If EL 6% apply, then EL 2.02% will not apply. Same thing, EL provision, EL 2.0 is applicable in respect of e-commerce operator where the threshold of 2 crore is crossed. As I told, 20 million rupees is threshold. If the e-commerce operator providing services in India and having turnover less than 2 crore, then the EL provision not applicable. So suppose you are selling your goods through your own website. You have make your own website. You are not selling through the e-commerce operator. Then this provision is not applicable. So this is simplified. So decrypting virtual digital asset BDA concept has been introduced by the Finance Act 2022. Section 247 BDA is defined. BDA is some kind of cryptocurrency. If you are dealing in Bitcoin, some Ethereum, then you are liable to tax under the income tax at the rate of 30% flat rate without deduction any expenses, without no set of losses is allowed to you. Further, TDS is 1% is also applicable to you over and above transaction 10,000. So under the GST, it will be liable to tax 28%, for which going on discussion under the GST Council, for which decision is awaited. Let us soon we will hear on this update. So what is going on abroad is OECD. OECD G20 country is considering two-pillar approach. BEPS, Base Erosion Profit Shifting 1.0, already has recommended 15 action plan which has been implemented in India through the various finance act, including action plan burn for challenges of digital economy. Now the BEPS 2.0 is under consideration by OECD G20 Pillar 1 Pillar 2 approach. Inside persuasive into BEPS 2.0, OECD inclusive framework on BEPS has been continuously evolving to address key term for agreement of two-pillar approach to the help address tax avoidance, ensure coherence with international tax rules. Ultimately, more transparent tax environment is work. Today, BEPS 2.0 also look to address the challenges arising from the taxation of digital economy. As ARGS, I am C. Ashwini Rastogi, we can help you, your client, what is impact through the BEPS 2.0 action and how you reform, determine tax liability and what compliances is to be done. Policymaker of Netflix told us that is the favorite news headline that if pillar 2 is applied, then all the group M&E companies need to work on hire army of accountants to understand the law and to implement the law so that compliances can be done. So now just we discuss on the what is the pillar 1 and pillar 2 in detailed manner. I will discuss in the next video. I just giving you important thing what is going on digital economy, what is the tax as per the present framework and what is the future in near term. So mark my word, which is important. If you are actually doing business in India, seated outside India, then goes gone days where nothing is liable to tax. Now everything is captured. So pillar 1 is talk about reallocation of taxing right. Pillar 2 is a global anti avoidance rule in respect of minimum corporate tax. Suppose you are doing a business through the UAE entity, your ultimate parent entity in India, and you have a subsidiary in UAE and Mauritius, then nothing liable to tax at their country because there is a no tax in that countries. So now they are triggered under the pillar 2. So what is the group? They define multi group under the pillar 2 require M&E group with an annual turnover exceeding 750 million euro. From two, four out of four preceding previous year, if year one, year three has more than 2750 million dollar revenue, then you are liable to tax through the Globe rule. Globe consists of four rules: subject to tax rule, income inclusion rule, under tax payment rule, switchover rule. So IRR, UTPR to be included in the domestic. As I said, my example, if you are doing some kind of business through the UAE based subsidiary, might be UAE will levy domestic minimum tax. Then no need to apply by the ultimate parent entity in India, IRR or UTPR. So if suppose UAE not levy tax, then ultimate parent entity IRR need to apply. So wake up guys, this is the alarm. You are liable to tax if you are not doing anything, not paying anything, might be triggered by the new law. STTPR, SOR to be triggered from the tax treaty, double taxation avoidance agreement. Globe rule, as I said, do not compel any country to adopt minimum tax rate. Suppose UAE not adopt minimum tax rate, then automatically counterpart country ultimate parent entity need to apply IIR. If the source country does not levy minimum tax rate, then the other jurisdiction would have right to tax. So what is the pillar one? Pillar one is kind of reallocation of taxing right. Pillar one focus on the fair allocation of profit, taxing right among the country, home country and user country having nexus. So in the pillar one, market nexus is focus. Presently, income is taxed on the basis of residency, source base, but new thing is come market base. So M&E in scope global turnover of above 20 billion euro to be reduced to euro 10 billion after 7 year post pillar 1 is effective. So 25% of residual non-routine profit but above 10% will be shifted to other country to the where the actual profit is pertained, where the substantial activity is going on. So pillar one adjustment is A plus B. A seek to allocate M&E deemed residual profit to market jurisdiction where the formulaic global base approach. Fixed base return for market and dispute function based on the arm length principle. Seeks tax certainty through the effective dispute prevention and resolution approach. Hope, hope so you understand the things. Something is going on presently. EL, GST, income tax through the permanent establishment, SCP, as the business connection in India already been taxed. And there is two limb in the equalization levy, 6% in respect of online advertisement, 2% in respect of goods services provider or by the e-commerce operator. Those are already triggered. SCP concept is already been in phase. So now onwards, the OECD is working on pillar 2 approach. So they want minimum levy of corporate taxes. So this global rule will come in phase manner. Thank you guys. Hope so you like this video. Subscribe my channel and so that in future you will definitely get this kind of video.